Hello, YouTube, and welcome back to another video. This week, we're going to be talking about the historic move that we saw on Thursday, the incredible 5% from low to high move, but we gave a lot of it back. We're closing the week down by 1.42%. And I really want to talk about how the stage is set because as we are now really throttling this 200 weekly moving average, I can now see a bull and a bear scenario for roughly the next 2 weeks. I'm going to quickly preview those. And then we're going to come back and explain everything because as of right now, there is a really important level, 34912, which we actually tested at the open on Thursday. And that is what I think really caused a large part of that short squeeze. But there was also some CFTC data which showed us that they actually reduced by another 50,000 contracts from our high of 280. That is roughly a 50% reduction. So they added back and then removed what they had back in late September. So this is so important because this next week is going to stage where we're going to go for the rest of the month, but potentially for the rest of the year. And as we look at what the scenarios are, first of all, we have to frame the conversation in telling us that the 60-40 portfolio or 60% bonds, 40% stocks is now had its worst performance in more than 100 years. So we're due for relief in a market that is extremely fearful. And we've not really had any relief for more than a year. We've been in fear or extreme fear for the last year. So with that in mind, I see two scenarios setting up right now. Scenario one is what we do on the average year. The average year in a second year of a new Democratic president, we drop down. We drop down for the sharpest drop of the year, but not the biggest percent decline, but ultimately rally up into the end of the month and actually close green. That is what we normally do. October is normally a green month in a second year of a new Democratic president, but also for all years, which is the black line. And that would also really align with our 2008 thesis where we drop down a little bit more, the red line being where we are right now, the white line being 2022, and the yellow line being 2008. So we are due, if we're going to repeat history and we're going to repeat the seasonality chart, we should have a drop down here and then find some relief where we can carve out that bottom. And that's really what we're looking for here. This lines up with the end of the year as well, but we're going to deviate going into December where we start to slide again. Scenario two is that the big bounce that we just saw is even bigger than what we had in February. And remembering that the February move was actually our lowest low. So we had low. Let me actually just draw it here to make sure everyone can see it. We have our low, lower low, lower, lower low, lowest low. And on the lowest low, we gap down, pump up. The bigger the gap down, the more we want to buy it. And that's exactly what happened. They bought it up. So as we look at the economic calendar and what could drive the market for this next week, I want you to pay attention to what could happen. How could we actually carve out some higher lows? Because there are some big headwinds. History is not really on our side. So if we're going to keep going up, I could see us curling up this next week, not actually going down like we do seasonally. And then if we get some bad news like earnings next week or more, even the bond market in England, we can form an area that we need to defend or well-defined risk. We can bounce up, we can come down, and then we can ultimately lose this going into next year and still repeat that 2008 if that is where we're headed. This is so important for me because as we look here, from the time that we stage our new low of the year to the time that we retest it and lose it again, it's roughly 70 days. Roughly 70 days from where we are now takes us to mid to late December. History does not repeat itself, but it often rhymes, and this 100% rhymes for me. So as we look at those two scenarios, and we now have laid out what could take us down, what could take us up, we're now going to look here to what could cause us to go down this week. What could cause us to go down this week would be Liz Truss as a harbinger of financial doom. Whoa, that's quite the headline. The UK has its own problems, but the rest of the world may soon have similar ones. Hey, America, we're going to come knock on your door and we're going to come take your markets down. Remembering that the bond market is actually bigger than the stock market. The most powerful buyers in treasuries are all bailing at once. Fed, foreign governments, commercial banks are all stepping back. More pain for bond investors may be in store amid buyer void. The Fed's next crisis is brewing in U.S. treasuries. The central bank can't afford to let the world's most important market seize up. It must act now to restore liquidity for treasuries. Again, the most important market, not the stock market, it is the bond market. That is the most important market in the world. So as we look at a economic calendar this week where data is really light, it's really only on Thursday with PMI and initial jobless claims, we are 100% going to be focused on what Liz Truss has to say, what our government does, what their budget looks like. And after that, the second, so to frame the conversation, if we're going to get this move down here, I believe it is going to be largely led to the most important market in the world seizing up in the UK, and then that contagion fear spreading to the United States, maybe to other markets as well. After the IMF report this week, where they told us that 1 in 3 countries is going to potentially fall into recession this or next year, it's already pretty dire out there. Now let's talk about a bull scenario, because these bulls love a nice bull scenario. Let's go back here to our chart to see exactly what that would look like. It would mean we didn't really 100% repeat this. We did actually fade into Friday, so that's okay. If we are able to rally up and actually form 1, 2, 3, 4, 5 days, that would be an up week. So it could be an up week if we're going to repeat this specific part of the pattern. So again, we're looking here to the next roughly 4 bars. That would be these bars right here. So if these bars are going to repeat, it means that we should be closing with an up week. I can see some evidence which could cause us to do that. We have here, let's frame the conversation here. We talked about there not really being very much data this week. So if there's not very much data, what is important? Well, it's earnings. Earnings are really important, with Netflix and Tesla both coming in after the bell on Tuesday and Wednesday, respectively. Everything else is more secondary to me, because these are really beaten down. Netflix down by 75, Tesla down by 50. I'm watching really close. There's other important companies here like Snap, like for Momo, American Airlines for travel, and a whole bunch of others. But I really want to focus on these two, because that's where I think the market's going to be focused. As a reminder, next week is going to be the most important week for earnings. So if we stage this, if we stage a move lower, what could cause us to take that secondary leg down to really repeat the we're going to waterfall would be a follow through of negative sentiment next week from the largest companies. Remembering that Apple already pre-announced or guided down. So next week is all about earnings. This week is about a preview for earnings, but really the bond market. And as of right now, Wall Street is still completely delusional about the pain that's about to hit the stock markets. So as of right now, Wall Street analysts expect the S&P 500 companies' earnings per share to hit 229 in 2023, a steady increase from where they started the year at 211, which means they think companies are going to make more money than they did at the beginning of the year. That is like way too optimistic. What's really important here too, from Mike Wilson, which is a quote, this guy accurately called the bear market. And now he's saying that markets often need the engraved invitation from a higher power to tell them what's going on. For the bond market, it's the Fed. And for the stock market, it's company managements. So that's going to really come down to what they report and what they forecast. So what we're going to look at first here is going to be Netflix, because they report on Tuesday after the bell. And Netflix right now is actually expecting a beat, an earnings per share of 231 over the consensus of 211. And that is important because when we go back here to Netflix's chart, we can look here and see that the stock has already been absolutely crushed. It is down by 75+%. They've now also introduced that, I think it's $7.99 plan that's ad supported. And I think that that could cause Netflix to beat on earnings and then also to guide higher, which would actually create a positive sentiment for the stock. And I can also see that the stock is also attempting to go to carve out a bottom, because we're seeing some pretty constructive green volume here. We're seeing sideways action, and we're actually holding a pocket of roughly the 2018 and 2019 lows. This thing could really rocket higher if we get a positive reaction to earnings. So that's the first thing. Second thing is that Tesla is now sunk more than 50% off its November record high, which means it might be due for that same thing we just looked at on SPY, where we have that big be So this is important because it also dropped 7.6% on Friday alone. And again, troubles pile up. But for Tesla, we're actually expecting an earnings beat as well. We're expecting on Wednesday after the bell, they're going to report 109 versus 101 consensus. So if that's the case, if we go back here to Tesla now, TSLA, we note that, it's actually 50. It's closer to 51% off the all-time high, I think. We got a dominant head and shoulders pattern. And if this is going to be a reversal, we have to pretty much start seeing it right now. It's also right down to that 50% retracement, which we just talked about, and we also saw on the broader market. So at a very high level, that is really what I'm paying attention to here. For the rest of these companies, I really want to hear what they say about the dollar in their forecasts, because In the screenshot here from Bloomberg, we note that Goldman Sachs's basket of domestic sales, which means sales in America, is the white line. They're doing like half as bad as the companies that have international sales. Why? Because that dollar is just so strong. It can't stop, won't stop. So at a very high level, we've now walked you through what could cause us to go down for the next week and then follow through into the following week. But we also laid out the bull case. And honestly, I'm hearing so many people talk about 2008, and they're all saying that, oh my God, we're due for such a massive move lower. It's not that I don't think we can go down. It's that it's a law of diminishing returns. And we've already talked about this story ever since, I think like roughly February, we started bringing it in. So what's more important for me is to be receptive to what could actually cause us to go up and what could cause us to go down. If next week we start to do the move lower, like we are expecting here, then I will talk about the 2008 update, which would really come back to whether we're going to get that dead cat bounce and then ultimately fail going to the later part of the year. I would also note that there is a potential meeting that could happen between Russia and the US because Lavrov said that if they offered a meeting between Putin and Biden, they might accept it. So that could definitely come in as a nasty surprise and cause a lot of buying. So now what I want to focus on are going to be the most important charts to focus on for this next week, now that we understand what is going to drive us, either bullish or bearish. And one more thing I would just note is that even though we laid out both a bull and a bear case, what is happening right now is that the stock market is not doing what it normally would. When we saw the PPI and CPI numbers come out, we did not get a negative reaction to what we would have expected. And I believe the reason why is because we've been in extreme fear for more than a year, either in fear or extreme fear for 12 plus months. So if bad news can't take us down, I believe there could be an oversized move higher if we do get a whiff of good news. And I'm not the only one who thinks that. Why? Well, when we look here to the CFTC speculators net short positioning, they actually took off another 1/4 of their position, reducing down to 164,000 contracts short. To not overcomplicate things, they've now roughly reduced their short position by half, which was at a peak in September. And then they're actually back to where they were 2 weeks ago. They added 50,000 back, and now they've reduced it by roughly another 50. So that's really important because this has really been what I am trying to understand. Why 349? Well, we broke 350. We tested our monthly moving average, and really interestingly, when we look here to our 3-month chart, the only time we put in four consecutive red quarters is in 2000 and also in 2008. So that is like pretty strong evidence that we could be going lower. But until we actually start getting closes below the 50 monthly, which we're kind of like set to do it, and then we also look at the weekly chart, I think we want to try to just understand why did we bounce exactly at 349 on Friday. So what I'm looking at here is going to be a Fibonacci retracement going from our lockdown lows to our all-time high, or the incredible run that we had. What I'm looking at specifically here is that same number we just looked at on Tesla, the 50% Fibonacci retracement. Right here it is at 349.12. If we now have a look here at S&P on its absolute crush of a day, where did it open? 349.21. Oh my goodness. That's like within, right? That's like within 10 cents of the level. That's right. They're just like, buy, cover the shorts, exit the puts. And I walked through that on Friday as well. They closed out, I believe it was 50,000 contracts on the 350 put for Friday. Why? Next Friday's OPEX. We're going to have a whole bunch of spice activity going into the 21st. So as we look at the S&P and the move higher, we can really understand that the math stuff is really coming into play. The second thing, which is really important, is that if we look to the numbers here, or our bear market or the red line at -20, and our bull market at, our 30% drop off the all-time high at -30, we're roughly in the middle. And we're doing a push-pull right here. So last week, we noted that we had 50,000 shares added back short. So they added into here, and then they covered it down into here. What this really tells me is that we're just seeing a push-pull. We're seeing massive volatility, but for the most part, we are spending the bulk of the time between roughly 357 and roughly 365, which just means they're taking full advantage of all this liquidity. It is beautiful. It is nice. This is a trader's paradise, but it is an investor's hell. So as we now look to the QQQ, very similar right here at roughly -30. We got 3 consecutive weekly closes below the 200 weekly. We got elevated volume with it ramping up. And this is really going to come down to what big tech can deliver. Is it going to fade? Is it going to bounce? We're watching really close. A couple more quick charts for us to look at are the things that usually are inversely correlated to the S&P. So if these things go up, it generally means the market goes down. Right now, the dollar has another fresh record weekly closing basis of 113.3. This is an incredible, incredible move. And we already showed you the significance of the dollar strength coming into earnings this week. If we now have a look here at the VIX, what is still missing for me to say that we have that capitulation like we've seen on every previous drop. We're now entering the box, which is the yellow one here, where we are elevated on the VIX over 30, but we've not seen capitulation like we did in 2018, 2020, 2015, 2011, which needs to get closer to about 45. We got to get to about 45 to really signal that capitulation on the VIX. Whether we go up or we go down, I'm not sure, but I really want to see closer to 45 head. Look at the 2-year note, remembering that these are inversely correlated. When these things went down, when they peaked in June, that's when the market went up. But since then, it's been on an absolute tear. And this is a fat week. It is up another 4%, hitting 4.5%. That is huge. That is bigly huge. Same thing here for the 10-year note, just a little bit more dramatic. Peaked in June, came down, and then since then, it has not been able to stop. Can't stop, won't stop. Long-term inflation expectations are 100% rising, and that is causing some weakness in the market. So with that said, I thank you so much for watching. And if you're looking for the things that are normally shared in these videos, those are now going to be shared in our private group. You can click on the link in the description if you want to find out more about that. Otherwise, thank you so much for watching. Thank you for the 10,000 subscribers, hopefully 100 soon. I thank you for watching, and I really look forward to seeing you on the next video. Thank you.